Okay, you might have to mute yourself there. Well, good morning. I want to start by getting all of you to think about the difference between micro and macroeconomic data. And I didn't mean for this to be a very difficult economics class at 8 a.m., which is when I took all of my economics courses, it seems, when I was in college. When they report the number of hamburgers that McDonald's sold, that is microeconomic data. When they report that less people are going out to eat and that consumer spending is going down, that's macroeconomic data. And what I've come to notice in the news lately is there's a lot of eye-catching, clickbaity headlines that are microeconomic data. So this morning, as I was getting ready, I had one of the financial news, cable news channels on listening, and they talked about how PayPal is laying off so many people right now. So you hear that, and you hear that Google is laying off people, and that a lot of people are getting laid off. But what they're not reporting is that the unemployment number is still pretty darn low, and that we're still adding jobs to the economy. Yes, we are laying off in the tech sector, which was probably overhired, particularly during the pandemic. But the reporting tends to focus on microeconomic data because it's more fascinating, it's more interesting, it's going to get more eyeballs, and news is less a service and more of a business these days. So I would encourage you, as you're listening to the news, as you're reading the news, or however you consume it, listening in the car, use that lens. Is this a micro story or a macro story? Because I'm noticing, and I haven't done any research on this, but I am noticing a lot of micro stories because I think they're interesting, but I don't think they're always relevant. And so when the economy adds over 100,000 jobs in a month, we hear more about the company laying off 800 employees or 1,000 or 5,000 or even 20,000. We still net positive are creating jobs right now. And I'll explain why that is important, I think, as we go through today. But that's just a little of things I would encourage you to put that lens on as you're listening to the news, because I'm noticing more and more that it's very easy to think, oh my gosh, there's really great news or there's really bad news. And it's easy to report on a very narrow slice as opposed to the whole pie, which tends to be an amalgamation and maybe a little more boring. So let's talk today about the economy, and we'll talk about where the stock market has been. We are now coming off of the most challenging year that we've had in stocks and bonds since 2008. And some would argue, as you've probably heard me say, that it was the most challenging year for bonds since George Washington was the president of the United States. So it was really a unique year in that regard. So let's just take a look at where we've been for the last 25 or 26 years or so. We've seen several bull and bear market cycles, and we're certainly in one of those now. If we look where the market was, it had a pretty rough year. It bottomed out at the end of September for the most part. And so since October, we've seen stocks come back and we've seen bonds recover as well. And so we'll take a look at that. So we're now, as of Friday, down 15% from the last time the stock market peaked, which was January 3rd of 2022. So the beginning of last year was the all-time high of stocks. And we're only down 15%, having at one point been down 25%. So there's a big hole that we're climbing out of, and we still have a way of climbing to go. But this just kind of puts that in perspective of where we are in the grand scheme of things. This is a measurement that I like a lot, and it's about how do we value the market? And it's looking at the relationship between a stock price and the earnings of that stock. Last quarter, if you were here or listened to this presentation, I would have said to you that stocks were pretty darn cheap. We were pretty much sitting at an all-time low for the last several years in terms of stock valuations. We saw earnings do reasonably well last year, but prices got hit hard. I don't know what the story this year is. There is concern that earnings will get hit hard this year. And if that's the case, we could see stocks get expensive again, even if they stay flat or go down a little bit. So what's happened since the end of September is stocks have come up. So the story of the fourth quarter, which we're kind of reflecting on, although this data does go through the end of last week. So you'll see January 7th is 27th is how relevant the data are. And so we're back above that long-term average of stocks. So when we see that middle line, that when stocks are at that line, we're saying stocks are reasonably or fair priced. When the gray line is below the center line, we're saying they're cheap. And when it's over, they're very expensive. And we like to see stocks inside the one standard deviation. We just say, stock market has a lot of variability and earnings is not the only driver of stocks, but it's a pretty core driver of stocks for the long term. And so probably if we go back to 2020, 2021, and the beginning of 2022, stocks were very expensive. Stocks got cheap, but they're not as cheap as they were. And if earnings go down and stock prices stay the same, that will inevitably push that gray line back up and make stocks more expensive. Again, this is not the stock market, but it's the relationship between stocks and their earnings. And so talking about the S&P 500, which is what we're looking at, is the 500 largest stocks that trade in the United States. And so it's always a good cross-section and a case study of where the broader economy and markets are when we look at those 500 stocks. And one of the things that I think that that's been driving the market, quite frankly, is the fear of inflation. So we've heard me say earnings are important, but day to day, the markets have reacted to what they think the Federal Reserve is going to do. And here we sit today, or here I stand, and this afternoon at 2 o'clock or 2:30, Chairman Powell, the Federal Reserve, will come on TV and he will announce that the Fed has done something. Many people believe that he will announce that it is a 0.25% hike on the interest rates. And I think that won't be surprising. That's what the market and the consensus is, that it will raise a 0.25 point. What I think will be important this afternoon to pay attention to is if the Fed chairman says, we're starting to slow down, because a 0.25% increase is a slowing down. When they were, a couple cycles ago, they were raising 0.75 point. In December, they raised 0.5 point. So to just raise a 0.25 point would indicate maybe they're slowing down. However, if you hear the hawkish commentary from the Fed chair, which would be to say, oh, we could do a 0.5 point very easily next time, or indicate that they plan to raise a lot more, I think markets will act negatively to that. What markets are hoping for, and if you paid attention yesterday, stocks are kind of uncertain, but they were generally up yesterday because they think, oh, the Fed's only raised a 0.25 point. They've got inflation under control. Fed's going where it needs to go. Things are going to settle down this year. We're going to be okay. That's the soft landing scenario. It's the idea scenario. It's the Pollyanna scenario. It's the one we're hoping for. Don't know that we're going to get it. However, where that relates to this chart here on the right is there are three kind of data points that come that relate to inflation when we think about the S&P 500 and companies. And so we're looking at pricing, we're looking at wages, and we're looking at sales expectations. And so the blue line is increased pricing in the next 3 months, and we see that going down. So that's companies saying we don't expect to increase pricing. But obviously last year everybody's increasing prices because of inflation. So that's a good sign. Plans to increase compensation seem to be slowing. We saw a lot of compensation increases going for a lot of reasons, but that's part of the inflation factor. And then the gray line is higher sales expectations. Expectations were lower. They're starting to rise a little. So this would seem to indicate, if we look at these three data points, that perhaps inflation is starting to taper, but we don't know. Just a real quick synopsis of where the stock market has been. You hear me talk about tic-tac-toe boards, and there's 9 categories of stocks. You have big companies, we have medium-sized companies, and we have small companies. We have value-oriented companies, we have growth-oriented companies, and we have things in between. I think the story last year was value did pretty well. And that's not really reflected on this chart too much here, other than if you look since March 2020, value stocks, if you look in the bottom center table, value stocks have outperformed their growth counterparts. However, if you look at the upper left chart, you can see that growth, whether it's large, medium, or small, companies over the last 10 years have outperformed value companies. So the big story with stocks last year was we had this long dominance of growth companies, and that rotation took place last year where value companies did much better. And that's not a surprise. Utilities, energy companies had their year last year. Growth companies, which a lot of technology, had a really rough year. Now, interestingly enough, year to date, so basically the month of January, with the exception of Monday and Tuesday of this week, we can see that growth has had a better start to the year than value. And so we're not really, it'll be very interesting to see whether that rotation goes back. But in all cases, if we think about the long-term perspective, last year stunk and for stocks, and yet, you know, since 2020, stocks are up. Since the low point of the pandemic, stocks are up really nicely. Stocks are still up nicely since before the beginning of the pandemic, and the 10-year average returns are good. So last year was certainly a step back, but let's not lose sight of the fact that long-term, we've had a really good go at it. So this is a chart that I've shared a couple times, and we've updated it here to reflect the start to this year. And it's the S&P 500 year-by-year performance. And the bar shows you what the S&P 500 did on the year. And then it also shows you that its worst moment in time during the year, and that's the red dot. So one thing to keep in mind is every year almost, the market loses money at some point during the year. At some point during the year, stocks were negative every year, going back for the last 43 years. But most of those years, 32 of the 43 were positive. Last year was an exception. And so we had a lot of years of good stock performance since 2008. And what we also noticed is last year we were down 25% at our worst point. We ended the year down only 19% because we saw kind of that 6% makeup rally in the fourth quarter. And stocks, as of the end of last week, were up 6% on the year. So we, again, continue to see some improvement there. But I wouldn't be all bullish at this point. I think right now there's a lot of uncertainty, and stocks are trying to determine if we're on our way out of inflation or whether it's going to be more persistent, and we just don't know. I also threw in the same chart for the bond market just to give you a sense of the kind of year that we had for bonds. Now, bonds typically are less volatile than stocks, and surely bonds didn't do as bad as stocks did last year. But at their worst, bonds were down 17%, ending the year down on average 13%. So this is the Bloomberg Aggregate Bond Index. And so we're also seeing a moment now this year where not only have stocks had a great start to the year, so have bonds. So we're starting to see some encouraging results there. I think that if the Fed does start to taper its interest rate increases and is headed on the trajectory that the market believes that it is, then I think bonds are going to have a good year. I think they'll be stable. I think stocks are going to tend to be more volatile. I think they're going to be more volatile because they're really uncertain of where economic conditions are going to land. So I've put this chart in just to kind of give you an idea of bear and bull cycles. On the left is going to tell us what the market needs to do the rest of this year to get back to where we were at the end of last year. So you can see if we can do 19.5% the rest of this year in stocks, we'll be right back to where we were at the beginning of last year. And that's not out of realm of possibility. I'm going to jump back 2 slides. We had lots of years. We've had lots of years in the last decade where we exceeded 19.5% return in stocks. So it's not out of the realm of possibility that we could be seeing new highs this year. I also want to caution that. I don't want to be Pollyanna and say, oh, by the end of the year, we're going to be great. If we average 10% over the next 2 years, we'll get out of this mess. If we average 7% over the next 3 years, we'll recover. So it could take us a while to return to normalcy. You'll notice on the right-hand chart that the average bull market lasts 51 weeks. Just incidentally, we came off the longest bull run in history going back for the last century. So that was 51 weeks, 51 months. We had a 131-month bull market. So that's, well over 10 years. If we look on the bear market, long-term average is 20 months of bear markets. So if this bear market that we're in started a year ago, we're 13 months into that. So this would suggest that on average, we're closer to the end than the beginning. But obviously, we've had bear markets that lasted 6, 7, 9 months. We infamously or famously had a 1-month bear market in March of 2020 during the pandemic. Thinking about economic growth, you can see kind of the trend, the long-term trend really for the last 2 decades has been about 2% growth. And people would like to see it higher, but honestly, that's been where the trend has been. And we're kind of getting back to that trend from the pandemic. So we're kind of getting back on track for economic growth. Could that get derailed this year if we end up in a recession? Yes, and we'll talk a little bit about what could happen. The chart on the right is one that I still like to hammer home for everybody is our GDP makeup. 68% or almost 70% is a rough number is based on consumer spending. Consumption, consumption, consumption. The reason this is important is the thing that will drive a recession is the health of the consumer in the United States. It is hard to have a recession when we have record low unemployment. That's why I don't like to listen. The reason that I think the financial news media likes to report that Apple and Google and Facebook and all these people are downsizing and laying off is unemployment. Rising unemployment is a sign, a strong indicator that we could push towards a recession. The reality is most sectors are still healthy. Most sectors are still hiring and creating jobs. We are not creating jobs at the rate we were a year ago. We're still creating jobs, not taking them away. So we're not losing jobs, we're creating jobs. Yes, there are companies that are taking away jobs, but there are still more that are making them than doing that. But I would pay attention to that macroeconomic trend. If we start to see unemployment, we see job loss on a net loss overall, we start to see the unemployment rate rise this year. And we'll take a look at it here in a little bit. That's where I think the risk of recession really starts to increase, because if you don't have your job or you're afraid of losing a job, you tend to stop spending money. And when 70% of your economy is dependent on people spending money, that becomes problematic. And you've heard that the Fed has this dual mandate: low unemployment or full employment and low inflation. They have said right now that they will sacrifice employment to keep inflation low, meaning they will keep raising rates even if it starts creating job losses. So this is the National Bureau of Economic Research, and they're the ones that officially declare a recession. And they look at 6 different areas of data to determine if a recession is present. They also look at GDP as well. So, but if you look at what these statistics are, you'll notice a trend: real personal income, less transfers. So people making more or less money. Non-farm payroll employment, household survey employment, consumer spending, retail and wholesale sales. Industrial production. So 5 of those are related to American workers and consumers. The industrial production is a little further removed from that. So again, the biggest drivers of data in terms of creating a recession are these 6 different categories that you're seeing. And on the far right, we do see one of them blinking red, maybe 2. We don't have the retail and wholesale numbers in there yet. That's why you see that white and blank in that box. Consumer spending is turning orange, but employment transfers, real personal income are all still green. So we are not on the precipice of recession. I would say, though, over the next 6 months, if these things start to change, then I would start to be concerned about a recession. Federal finances. So again, just kind of thinking about all the things that impact the economy. One of the things that I think, one of the contributing factors to inflation was the unprecedented amount of government spending. And so we're coming off of that as a result of the, coming out of the pandemic and the extra spending that happened, but we're still spending more than we're bringing in, which is another issue that presents problems to where we are. But on the left, our government this fiscal year plans to spend about $6 trillion. And it looks like we'll have about $5 trillion of income, which means we probably will have to borrow $1 trillion to meet the obligations of the federal government, another $1 trillion. And so right now, if we look at if we look at the accumulated deficits, they only report as a percentage of GDP. We're getting to that all-time high. So the bottom right just shows you that right now we're just below 100% of GDP in debt. But if this trend continues, we'll start to get to a place where historically, if you look back over long periods of time, when you get above 100% of your GDP in debt, things tend to get very challenging. And so it'll be very curious, and that's where your economy can really stall out. So there's a lot of attention right now in the news being paid to raising the debt ceiling. There are some in Congress that would like to see some spending cuts to accompany borrowing more. I think that that is a noble cause, that we should rein in our federal spending. I don't know that hijacking the federal treasury to do it is probably going to be effective. That could cause a lot of fear in the markets. So it's a political gambit. But the problem is that Congress already authorized the spending, and now it has to borrow to do it. And so the time to cut spending was before you agreed to the current spending that you've already committed to. That horse is out of the barn. However, markets could react very negatively as we get into June to the federal government not, hitting the debt. So we've hit the debt ceiling like last week, and now we have extraordinary measures where we have enough money kind of sitting in different pockets that the Treasury can pay bills through about June. Once we get to June, if the debt ceiling hasn't been raised, it could cause some panic and havoc in the market. We saw this 11 years ago. It quickly got resolved, but it was not without some pain to stocks and bonds alike. So it's just something to keep an eye on. When we do our second quarter update, will be in May, and maybe have a clearer sense of whether the Congress is making any progress at resolving the debt ceiling issue. Switching back to the consumer. So again, just to kind of jump back to the government a minute, we do worry long-term that the federal debt could dramatically slow the long-term economic growth prospects. And so Congress does need to address some of the spending, or raise taxes, or probably do some of both. So switching back to consumer finances, again, U.S. consumers still in really great shape. Just to put a couple things, if we added up all our money together, all 300 some million of us, we put all of our assets together, we have about $162 trillion. And if we look at all of our debt together, we have about 19 trillion. So the consumer balance sheet on average is still pretty good. Just to put some perspective on that, if you go back 2 cycles ago to 2007, and the peak of that economic boom, we had 85 trillion. So we still have almost doubled the amount of wealth since the last recession, and done that. On the right, though, upper right, is the household debt service ratio. And we were holding in around 10% leading into the years leading to the pandemic, meaning people were putting 10% of their income towards debt service. It's your mortgage, car payments, maybe it's credit card, all that kind of stuff. During the pandemic, that really dropped. People paid off debt. They refinanced debt really cheap. They saved money because they weren't going anywhere. And so we really saw that drop down to, decades low. But we're getting back to that level of where we were pre-pandemic. And I think what that means to me is in the bottom right, there's some good and bad in that. The good is people are taking more debt, which means they're spending more money, which is good for the economy. But obviously, if the consumer gets too upside down with debt, that can also be very problematic. Obviously, we were significantly in debt at that 13% range going into the housing pandemic, and that really created a lot of economic pressure that was negative. If we look at the household excess savings in the bottom right, this is very interesting. People saved a lot during the pandemic, and that blue line against the dotted line is, where are we? And we're saving a lot less money now all of a sudden. In fact, what we're doing on average is spending a lot of savings. That shaded blue area is showing that we had an extra $2 trillion sitting in the bank collectively as consumers, and that's getting depleted. It looks like it's down to 0.8 trillion or 800 billion. And what that tells us is part of what's been keeping the economy going is people are spending more, but they're spending savings. That trend will start to dry up this year. Now, some of that is logical, and we all probably have our own stories of trips we intended to take or commitments we had, money we had planned to spend in 2020 or 2021 or even 2022 that we now are getting to spend. So some of that was just deferred consumption. We couldn't take that great trip in 2020. We took it in 2022, or now we're taking it in 2023. I know lots of us have those stories. And so some of that's part of the story, but it's also concerning because we are burning through our savings. And once it's gone, it's gone. And once savings is gone, then debt starts to go back up. So it's good macroeconomically in the short term if people are spending, but we also need to keep those numbers in check. So the consumer has to stay healthy. Consumers certainly keeping the economy healthy. So talking about inflation, there's CPI and core CPI. So headline CPI, that's this blue line, is everything aggregated together. Core strips away food and energy. And, again, food and energy tend to be so volatile that it's hard to get a good sense of what the inflation trends are. But we certainly saw energy prices start to drop last summer. And so that blue line really started to come down last summer, but now we're starting to see the gray line trend down a little bit too. The markets have been very encouraged by this chart over the last several months, which is why I think stocks have done well since October. It's still not a long-term trend. And that's what I think the Fed will caution everyone to today at 2:30. And that's what I would caution everybody to. We still don't have a good long-term trend downward in inflation. And if you look at that gray line, it dipped down a little bit last year and then went right back up and then dipped down a little bit. So my point in this is we still need month in and month out of reasonably good inflation data. We've been getting it, but it's not, it's only a couple of months so far. We need more time. And so I think the Fed, you'll hear a lot of the talking heads say, oh, the Fed's going to overreach. They're going to raise rates too high. It's really going to push inflation down. It's already starting to go down. And I think there's some valid explanation there. But I think the Fed also is looking in this going and saying, we're not out of the woods on inflation yet. We need to keep raising rates. So you have this dynamic. The market doesn't like the Fed raising rates because it wants money to be cheap. It wants capital to be cheap. Wants rates low. That's good for stocks. However, the Fed also, what's also good for stocks is a healthy economy. And the Fed knows that inflation can really damage the economy. And so if they have to give a little too much medicine, they will probably likely do that according to them. Inflation heat map. And I thought this was interesting, but it's also a little encouraging. And I think this is where the people who would say inflation is heading in the right direction, the Fed just needs to chill out a little bit, would look at this data. And if we look at December, these are all the different components that make up inflation: energy, food, goods, apparel, vehicles, used vehicles, things like that. The only place we're still seeing red at the end of the last year is in shelter. And a lot of people would argue, and I think it's a legitimate argue, that shelter costs lag everything else. So the impact, we saw housing prices kind of explode over the last several years. part because interest rates were really low and it was very easy to borrow money at a very low cost and go buy a nice house. The problem is interest rates went way up last year. People stopped buying homes. Home prices haven't dropped. They've stayed high. They're persistently high. It takes time for interest rates going up. They say it's about a year of interest rates going up for that to come through in real estate prices. But we know that obviously there's a strong interest rate relationship between interest rates and shelter pricing. And that's because if I'm buying a house, it's going to be based on my ability to borrow. So what happened is people who are thinking of selling houses right now are either able to sell them or they're not selling them. They're not lowering the price because they don't have to. But that dynamic starts to change over the next several months. So I think where we're seeing most of the inflation right now, and this next chart also bears that out, is in housing costs. And we would expect that always because housing costs tend to lag a good year behind everything else in inflation. And if you look at these bars stack up what makes up the inflation rate. So again, since June, inflation rate has generally been coming down. We saw it hiccup a little bit there in August, but if we look at December, best reading yet. But if we look at what's compiling that, energy went way down. The green bar got a lot smaller. The purple bar has gotten a bit smaller. The gray bar, which is the other, has gone down a little bit. The blue bar, restaurants, hotel, transportation, it's been a little bit higher. But the shelter component is the part that is still the biggest driver of inflation. And if I go back a year, it was probably the smallest component. So you can see it has that lagging impact. Shelter has a lagging impact. And so there's a lot of people saying, because of this, the Fed just needs to give it some time. They're heading in the right direction. But the Fed also would say, we haven't seen a long-term trend yet, and we're not going to pause and then lose time because this could quickly change. So today we're going to find out where the Fed is and where it's going. The market and the Fed believe that it'll peak at, and actually this has changed a little bit. Let me back this up. The Fed has indicated that it'll probably peak around 5%. So it's at 4.38% is where it's at now. They're talking about going up a quarter of a point, which would put it up to 4.6 and put it about 0.5% off of where they think they're going to peak. If the Fed goes much above 5%, then I think all bets are off and things could get really dicey. The market thinks the Fed is going to start tapering sooner, like maybe now. I think that's a little misguided. That green line shows where the market thinks we're headed versus where the Fed thinks it's headed. The market has been right more than the Fed, ironically. Market has perceived data quicker than the Fed has historically. And so the market tends to be maybe a better barometer of where interest rates are headed than the Fed itself. But I think we could be in a bit of an exception right now. I can't imagine that the interest rate hike today is the last one that we're going to see for a while. I think the Fed thinks it'll keep hiking rates and has said so. I think the market is wishful thinking that things are going to level off here right now. Just wanted to kind of give you a sense of the damage that we've had in bonds, and what I think is the good news is what we've said is if the interest rates go up 1% more, what impact will that have on bonds? The reality is it probably won't have a lot of an impact on bonds. And this is looking at the right-hand chart, so that if rates go up 1%, long-term treasuries will get crushed, but that's not surprising. A lot of other stuff might go down a little bit. But if the Fed starts to cut rates, then a 1% drop in interest rates could lead to a huge boon in bonds. And so I think part of where market is hoping the Fed stops, maybe even cuts rates later this year, and that could be a very good year for bonds. So I think the upside potential right now is really strong for bonds. I think the downside potential we've gone through last year was all the pain in bonds. I think the downside is looking a lot better unless you're a holder of long-term treasuries. But this is a perfect example. It's like a 30-year treasury you could really do well on, or you could get burned on, right? If we bought some 30-year treasuries and the market and rates start to go down, that's a segment that could do fabulous, right? 20% increase in rates. Another sign of recession historically has been the inverted yield curve, and this yield curve continues to be inverted. So the bottom line is the gray line is the 10-year average of the yield curve. You can see your shorter durations tend to pay less, longer durations tend to pay more. Right now, I could lend the government money for a year and get 4.6%. Or I could lend the government money for 30 years and get 3.6%. So that's what we call a mismatch or an inverted yield curve. Every recession we've had an inverted yield curve beforehand. However, every time the yield curve inverts does not necessarily mean a recession. So when we keep talking about the risks of a recession, they're there. This is one of the things that people point to that, hey, this second half of this year could be bad. I think also the slowing growth in job creation has that potential to be there. But again, it's still positive. We're still creating more jobs. So those are the things to kind of keep an eye on later this year. I think by the time we hit summer, we'll probably have a little more idea of where we are, particularly with unemployment. And if unemployment is still low and job creation is still reasonable, I think the risk of recession is a lot less. However, historically, when the Fed has raised rates, and I have a chart for that, but I'll spoil a little bit. When the Fed has raised rates in the past, it has ultimately pushed the unemployment rate up. And so at some point, like mortgages and housing, it becomes a lagging factor. And so there's a good chance that things could go the other way. Another interesting rotation in stocks that I think is notable that we're seeing is when has Europe and the Far East, or kind of the rest of the developing world, outperformed the US? We have for 15 years been outperforming the rest of the world. US stocks have been the king. There is a lot of data that would support, and this would be it here. We're at an all-time low in terms of the relationship of developed stocks to US stocks to developed international stocks. So we see more of an opportunity now in international stocks. We think they're way undervalued relative to their US counterparts from a historic standpoint, and we see that here. So many are predicting that we will start to see international stocks do better than US stocks this year. Hasn't happened yet, but it's certainly at a place where it would not be surprising. And so finally, and I realized I thought I had a chart in here and I took it out, but the relationship that I was trying to imply is the relationship between unemployment and interest rates. And so they kind of have this inverse relationship. So as interest rates go up, unemployment historically has gone down. We're waiting for that shoe to drop on unemployment. Haven't seen it yet. And so that'll be very interesting. And then finally, it just talks about time and the diversification of money. And this is just a helpful reminder to all of us as we conclude, is that stocks can be very volatile. We can lose 40% in 1 year or 39%. That's this green bar. And we can make 47% in 1 year. Bonds could lose 13% in a year, AKA last year, and they could make 43% in a year. And a blended portfolio of 50% stocks and 50% bonds could make 33% in a year or could lose 15% in a year. But when we start getting out to the 5-year rolling averages, what we see is a diversified portfolio still makes money in any 5-year period going back to 1950, in a 10-year period, and in a 20-year period. But there were a few exceptions where 5 and 10-year periods, we saw stocks and bonds negative. And so the point is diversification is really important. Holding both asset classes is really important. And so just kind of finally, what's interesting to me is this chart does shift around. And what's become clear to me is if we look at the last 10 years, 10-year annualized return by class stocks, in spite of last year, still are the best performer. Now, I'm just noticing that this data is as of the 2023, but so you can see stocks average 16.6% over 10 years, small cap, and so on. You can see the different things. But a 60-40 investor still averaged 11% from 2012 to 2021. Excuse me, that was the period of the bull market. That was before the bear market started. So the point is, we want a diversified portfolio. And what's also interesting is a diversified kind of moderate portfolio, 60% stock, 40% bonds. That's that blue bar on the bottom, did better than the average investor. The average investor who did not have a strategy, did not have any diversification, was probably, this is people playing around with their 401ks primarily, did poorer. So having just a good diversified 60-40 split, set it, forget it, still in a bull market led to double-digit returns. So that concludes just kind of our observation. If you were hoping to leave today with a definitive thought on where we were headed, I apologize. Good luck to you. I think the data is not clear yet. I am hopeful, and many are hopeful, that inflation is headed in the right direction. That trend will continue, and the Fed will, quote unquote, execute a soft landing, which means we get inflation rate down to an acceptable level, which should probably be under 3%, without having to push the economy into recession. The way we get pushed into recession is when unemployment goes up and consumers stop spending. Neither of those things have happened yet. And so the idea of a soft landing is still very possible. And I think as we get to summer, we'll have a clear sense of that. We'll have a clear sense of if inflation has indeed stayed on that downward trajectory and if unemployment stayed low. Those are the two big things I would watch. And I think those are the two things the stock market is watching. And I think that's what's driving stocks right now are those big macroeconomic factors of unemployment and inflation. So I'm going to just share a couple disclosures for you that it is really important that you have all the definitions here. This presentation will be posted online, and you can go back and read this on your own. All the data was as of January 27th, and I came in this morning and had an email that we needed to add a few more disclosures because there weren't enough. And so we've done that. And I do encourage you to take time to log into our website. We will post this presentation to it, and be sure to read through all the fine print. Most of that data, most of that fine print is telling you the following: is a lot of glossary definitions of all the different measurements that we used in the presentation. We've attempted to do that in a way that I've tried to explain those as we've gone along. We also want to tell you that past performance is not indicative of future results, and so those are the kinds of things that are important that you know. And these are our sole opinions. Our data does come primarily from JP Morgan, as you can see. They are a great partner. We use some of their investment products, and they help us. They're able to help us by providing very current data. Their data set gets updated literally every day. So Monday, we were able to get Friday's data. That's everything I have for today. Does anybody have any questions, either online in our chat or here in the room? Yeah, Rich.
When you talk about job losses and then job gains, we always talk about numbers.
Yeah.
What about the earning value of the lost jobs compared to the earning value of gains?
It's a great question, and I don't have any data on that. What we do know is real personal income is still kind of increasing. So that would suggest that doesn't necessarily mean that. That it would suggest that as real personal income, less transfers go up, that earnings are still there. But what that doesn't tell me is maybe I'm working too part-time, or maybe I'm making less in my full-time job and have a part-time job. So I don't know anything on that other than what I've just said.
But is it tracked?
I am sure the Bureau of Labor Statistics probably does track that to some extent. So, and you're fully employed. I mean, also what's in those numbers is you're fully employed even if you're working part-time, which is not true. You know what I mean? Practically. Also, if you're unemployed for more than 6 months, they stop counting you as unemployed. And so, that's because some statistician somewhere determined once upon a time that most people give up and stop looking after 6 months. I don't think that's true for most people, but so the unemployment numbers that we look at are important, but there's lots of stuff beneath the surface. I mean, workforce participation is still down. So there's, part of the reason that unemployment has stayed low too is that less people are working, less people are looking for jobs. And that happened during the pandemic, whether by choice in a lot of cases or by necessity, whatever. And so the unemployment, there's a lot of data beneath that we just don't have or are able to dig into. All right, well, not seeing any more, I'm gonna conclude our presentation this morning, and